Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 30th, 2018. Wanted to do a quick market update, just take a look at a few of the things that I've been covering in recent weeks. We'll recap, quick look at the broad markets, where we're at, what to expect going forward, at least this week here in the near term. And then I'll revisit some of the things that I've been covering lately, such as crude futures or crude oil, of course, Bitcoin. What else is there? That's mainly it. I may talk on a couple trade ideas if there's time, if I can keep this video short. I don't plan this one to be very long. I'll start out here with QQQ. I did have a request on the site for more updates on QQQ. I try to incorporate um, ETFs and ETFs or individual stocks are always the official trade ideas on the site, although I'll often post analysis on the futures chart because it tells us a little bit more. You can see what's gone on around the clock. You can see the after hour trades and into the night. So sometimes sometimes I'll notice a development, a trend line, a key support level that shows clearly on the futures chart, whether it's ES, which are the futures for the S&P 500, or NQ, those are the E-minis for the Nasdaq 100. But what we're looking at here, forget about all the lines above for now. Those were past resistance levels, support levels at the time. In recent weeks, I've been harping a lot on this 160, 161.66, we'll call it 161.70, give or take a few pennies. That level, which defined at the time it was resistance. We had had several failed attempts to get through there. It was also the inverse head and shoulders pattern. We broke out finally. We back tested along that level for a while, which helped to validate it as an important support level at the time. Remember, resistance once broken then becomes support, and acted as support again there. And then we broke it. And then once we broke it, you can see, as is often the case, especially on a well-defined level, there was very impulsive selling. So we fell down, we rallied back up, we regained it. There was a lot of noise here, and the reason we've sliced through that level so many times, typically when if I have a pretty well-defined trend line or support resistance level I'm watching, it's working well. But at some point, prices start slicing through it like it's not even there. At that point, I give it a little less credibility, or put a little less stock into it. This move here was induced when we had those three big earnings reports last week. Who was it? Intel, Amazon, and Microsoft, if I remember correctly, those three. And we had Intel and Amazon really pop huge in after hours, and then see a lot of that faded. So we're going to look at the futures charts, and that'll show you that after hour pop. But you can see this was a big reversal there. We still closed today green on that candle, but we closed down. We faded most of the gains intraday, and that was pretty bearish. So I wanted to talk on that development, what's happened since then, and also keep in mind as I'm doing this video, we have the biggest component of the Nasdaq 100, the S&P 500, Apple, reporting Tuesday after the bell. So things are going to change, or could change. We saw what happened when Amazon had a big blowout quarter, at least what happened initially. And then, as I often say, if you followed me for a while, for years, I've always said this: it's often not the initial reaction on a stock when it reports earnings, or on a Fed day when the Fed announces rates, what they're going to do. Be very careful, and don't act on that initial reaction, whether it's a rip or a dip, because very often that initial reaction's faded. And even at times there's a big subsequent big reversal and that gets faded. So don't assume that the initial market's reaction, the initial reaction to a big earnings beat, is going to be the lasting reaction that sticks. In fact, when it's not, when you have a blowout quarter such as Amazon did, and you have a huge aftermarket rally, when I say huge, relatively speaking, it's a mega multi-billion-dollar company. So even a 5% lift in a stock like that is considered huge. Everything's relative. You have a little micro cap stock, I can jump 30, 40, 50% in a day. All right, so that we're going to get to those charts in a second. And again, don't try to make too much out of the next couple of days, because the markets usually, anything can happen. That's one thing about trading. Always be prepared for the unexpected. But normally the market will go into a holding period before a big earnings report or before a big FOMC announcement, and kind of grind around aimlessly. Nobody really wants to take a big position right in front of a market moving event like that. There is a gap right here, so this is what I'm watching on QQQ, a gap to probably be backfilled. I'm also noticing a recent bearish crossover on the PPO. Last time we had a bearish crossover was right here. You can see what happened at that time, and I like to see clean separation between the lines, between this blue line, the PPO line, and the signal line, that dotted line there. So usually when you get those bearish PPO crossovers, they're at least near-term sell signals. And again, this is a 60-minute chart here, so that's something else to note. Plus the fact that we have faded 100% and then some of those of the gains that followed in the wake of Amazon, Intel, and Microsoft. And it was really Amazon and Intel that led the way there. Microsoft, I don't think did much. In fact, let's take a look at those two real quick. Right after, actually that evening when they were they popped big in after hours session when they reported both of them after the bell last week. I gave a scenario of what it would look like, what the charts would look like in advance, and showed you that even though they were up in the after hours session, that the longer term outlook had not changed. There were bearish divergences in place, and would be as I said, the stock would have to move, and this is Intel, of course, the stock would have to move substantially higher to take out the divergences that were in place. This 57.77, I believe, if I remember right, that's the mark after the big pop and after hours. That's as high as the stock got. So you can see from that point, those that chased, the initial positive reaction to earnings and bought in, whichever poor sucker bought at the highs at 57.77. I'm trying to grab it close enough. They've already lost over 11%. That stock has given back 11% of the after hour, almost a little bit more than that actually. And when you look at that, that's a big red bearish candle. And again, the divergences are still very much intact. So we have this bearish rising wedge pattern defined by these two yellow lines. And of course, the stock still has quite a bit of support. Each of these are support levels. So your first sell signal would be really a break of that trend line. And since we have horizontal support just below around 50.68, you want to see that go. Again, these do not show, these charts I'm looking at do not reflect the after hour trades. This is the regular session trade. So we had a big beat that night. We went well above what you see here at the top of the chart, and we faded 100% and then some of those post-earning rallies. So that is hard to be construed as anything but bearish in my opinion. And then the other big one, of course, was Amazon. And Amazon, again, had a big pop, big gap up, closed the day green, but faded a lot of those gains. You can see it still also has, significant negative divergences. These divergences haven't been confirmed. That's just a term I use because, technically speaking, this is negative divergence because we have prices making a higher high from the previous high, actually these three highs. So we had negative divergence here at this point because these indicators, the RSI and the PPO, made lower highs versus prices making higher highs. But what we did is we thrust up, we made a marginal new high, which was still a divergent high because this line you can see at this point we're still making lower lows, or I'm sorry, lower highs on the indicators with a higher high in price. And very often, you've heard me say this too, it seems very often at most you get about three consecutive divergent highs, and you can view it as separate divergences because there was a correction after that first divergent high. You can see right there. But this is really just an extension. When you have back-to-back divergences, it's just consecutive divergences or an extension, one larger divergent high. So that's Amazon. You want to look at it on the 5-minute chart. You can see there was that big pop, and again, it went higher than that after hours. And we faded a lot of that, but we still would have to backfill this gap to really firm up the bearish case. Amazon, if I were to short any of the FANG stocks, this would probably, at least at this point in time, would not be my first choice at all. Probably be one of my last choices. Well, let's just take a look at the futures real quick because it shows, what happened, uh, that evening when we had the big pop. I'll actually zoom down. This is a 60-minute chart, so this goes back 2 months. These are hourly candlesticks, and as you can see here, we have these trend lines. This is really a swing trader's time frame, and it's been a very volatile market, full of opportunities for day traders, but plenty of opportunities for swing traders. You just have to have your you have to be in a sort of a fast forward mode, more active swing trading. Instead of looking to position for several months like you might on a normal swing trade, with this volatility and these big price moves, you can make comparable gains in just a matter of days or a couple of weeks during these trends. I'm referring to since the beginning of the year, we had a sharp rise into the late January highs. Actually, this chart that goes back to March. I'm sorry, so we missed that there. But then you can see from mid-March, nice correction. That ended with, by the way, you can see the divergence lines back here. This was a divergent low. This is when we were getting bullish on the Qs. This terminated in a divergent high. And that's when we were getting bearish and was going to short on the Qs. And most recently we have a very small divergent low back here. I think that occurred on that Wednesday I was out. That's the only day I've taken off this year, and I was away from my desk at the time. But that led to a pop there. You don't have, at least doesn't show through here, not big divergence. If I went to a smaller time frame, you would see divergence. And again, it depends on your trading style. If you really are a very active trader, you zoom down here. This is a 60-minute chart. That divergent high I just drawn out there would show better, much better on a 15-minute or a 5-minute chart. And I'll even look at that real quick for you. So far, not good. And what I'm looking at, let's go down to a shorter term time frame here, and I'll tell you what I'm trying to get to. Okay, this is what are we looking at here? 15-minute time period, 15-minute candles on the NQ, the NASDAQ 100 futures. So this shows you that the big after hours pop that was induced by almost exclusively by Amazon and Intel. You can see that carried over to the next day's trading, and then a 100% and then some fade of that. So that's bearish. This on face value is bullish, but when you have a reversal, you faded all those gains and then some. And then what happened from there? The market tried to push up, made it about halfway up or so. I'm referring to both, this big pop here and then the subsequent rip. Made it about halfway up, and that's actually must be a level that I have going back to the left of the chart, resistance level around 67.05 right there. And it failed at that resistance level, and it has since moved even lower, another impulsive thrust down. So now here's the bottom line. We are well above, we're consolidating today for the most part, but we're consolidating below where all of this took place. And that doesn't look good for the bulls. It shows that, on stellar, a blowout quarter, again, everybody was just, amazed at the growth, especially on Amazon, and even Intel had a big run. But see, the important thing in trading, it's not what a company says. It's not about the FOMC, what the Fed says or does on their rate hikes or what they don't do, or what a company does on earnings. It's the market's reaction that matters. That's all that matters. Because if the market gets sold on good news, that's a change of character. If you remember, for the last year and a half or so, pretty much any time since the Trump pump, good news was good news and the market rallied, but bad news was dismissed. Didn't matter what North Korea was doing, what was going on around the world, what kind of negative headlines were coming out. The market went up because it wanted to go up. There were more buyers than sellers. But when you start to see this change of character, you see some very good news, market pops on it, and then that's sold off. That's a change of character, showing you there's more sellers in this market, at least at this point in time, very near term, looking to get out. They took advantage of that pop and they sold it. So right now things aren't looking so hot there. But again, this is a 5-minute chart, and we're still sort of, the bigger picture is grinding around in a range where we've been at. Let's see what happens with Apple. I remain near-term bearish, but it's not. I don't think it's time to bet the farm on that, because this market still could go either way. Can't rule out new highs anytime soon just yet, because we're still between the highs from the 2018 highs, and we're still above the lows. We've had two roughly equal double bottom low as well. So we need to break one way or the other from that range, and that will probably determine the next 5 to 10% or more direction in this market. All right, for you S&P 500 traders or ES traders, these are the ES E-mini, the S&P 500 futures, and you can see the lines drawn on the chart. It just basically shows, you see uptrend lines, you see this one terminating in a bullish rising wedge. I'm sorry, bearish rising wedge. You can see the negative divergences that came in at that high, followed by a correction. Again, these are the swing tradable trends. You had divergence here, it led to a little bit of a rally, and then boom, a sharp sell-off. And there was that recent divergent low. So again, this is a 30-minute chart. We were looking at the 60-minute on the NQ, and most recently the the S&P 500 futures, put in a divergent high. Pretty clear, nice separation between the peaks here on the PPO down below. You can see on the RSI, and so far that's playing out for a correction. All of these lines below are support. This is a pretty decent support zone right here. And so, like I said, there's work to be done. We're in a grind right now. You can trade off these shorter term intraday charts if you want, or you can stand aside if you're an investor. Let this week, at least this week, we have, once Apple's out of the way, we have a couple other big, companies, but from here on out, the earnings taper off. So at that point, it's a little safer to dip your toes back in the water. I'm talking about swing traders, investors, because we're just now coming off the peak of earnings season. So once you have all those big market leading stocks out of the way, you're not risking a huge opening gap against your position, especially if you're a swing trader. That's again my primary style is a swing trader. That's the bulk of the trade ideas on the right side of the chart, but I do go into day trading mode personally, and I share some of those trade setups on the site. During periods like this of extreme market volatility, and the benefits are you can get, with intraday swings of up to 3% or more in QQQ recently. From the highs to lows, that's tremendous profit potential. If you get in there, especially, the nice thing about day trading is you can leverage up quite a bit because you do not have overnight risk. So you can take an oversized position, and to make 1, 2, 3%, even 0.5%, depending on how much leverage you're using, is putting a lot of money in your pocket. And then the beauty is you close it out at the end of the day, so you don't have that overnight risk, and you sleep well at night. But that's those periods don't come often. We've had it now. It's been a few months where we've had this elevated volatility, and eventually that volatility will abate and we'll return to a more normal swing trading mode, especially now that earnings season's starting to wind down here. Here's crude futures. I'll show you USO in a second. And I know a lot of you guys on the site like DWT, you like to use the leverage ETF, so we'll take a look at that one as well. But in charting, first and foremost, I look at the futures, and then I'll look at the other the ETNs that track oil. But all they're doing is investing and trying to roll futures anyway. So you want a pure play on trying to read the charts. This is why I go over the futures. I'll trade them personally, but I don't put them as trade ideas because the vast majority of retail investors out there don't have access to a futures account. So, but I think it's important to incorporate that into your analysis. So, where am I going with this? Same story. I've been saying this for weeks. I'm ready to pull the trigger for an official trade. I've been trading crude. Um, I still have a short position. I'm waiting to add when it breaks below 67, which I think it will. And until then, you can see that it is simply locked in a sideways trading range. And this, if you read the FAQ page under the ETF trading related questions, this is when you do not want to be in a 3-time leverage ETF, especially in a volatile instrument, when you have back and forth sideways trading ranges. That is when you get the decay, where you want to own, if you are going to trade 3-time leverage ETFs, anything more than a day trade, you want to be in what I refer to as unidirectional rips and dips that are obviously in the direction of your position, because in that case, you have minimal decay. In some cases, a decay actually works in your favor, meaning you can do better than 300% what the underlying commodity does if you have a fairly unidirectional trend, meaning very few closes, especially it's all that matters are the daily closes anyways against your position. We're looking at a 60-minute chart here, but that's the big picture. Sooner or later, crude will break from this range. I still favor a downside break. I'll have to respect an upside break, especially on a 60-minute candlestick close below, and even more so on a daily close below that. But as of now, it's more the same, just noise within this trading range. So, a swing hit the pause button there by mistake. Swing trader, if you're very active, you can continue to buy crude futures when it down around that 67 level, and you can sell. As I mentioned, the trading room we ran up here today, that high is about, what is that, 69.40, give or take. You can short at the highs there. With a stop not above, or when you buy down here with a stop not below. But my guess is usually tap, 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 three strikes on your out. It's possible to have another reaction off that level, but my guess is if crude falls back down again to 67, we'll break it. But until we do, we're in the range, and support is support until broken. So you have to respect that level. And this is a daily chart of USO. This is one of the more liquid, popular crude tracking ETNs, non-leveraged, so you're not going to have the much decay there. And you can see there's a very well-defined trend line. So this is the bigger picture for crude. You have a well-defined uptrend line. You have a divergent high right here, which makes up a bearish rising wedge pattern. You can see the negative divergence. You can see it's confirmed. The PPO is now rolling over. That's why I favor a downside break. That's why I think we're coming back down. But when you zoom in tight, you can see the same story on USO, which is this recent sideways trading range that we're in. So frustrating if you're in a position. You may be, at break even. And if you're in a non-leveraged instrument, again, not as big of a deal. If you're patient, you can wait it out. But an objective short entry will come on an impulsive and definitive breakdown below the bottom of that trading range. DWT, and there's many different inverse crude ETNs out there. Some are leveraged, some are non-leveraged. Obviously, the chart's going to look just like USO in reverse. This is a bullish falling wedge. You have a divergent low. That divergence is just now, looks like we're just starting to get across, not a clean crossover yet. But any downside in crude from here will be upside in DWT. And same story, a breakout above this recent trading range. I'll put a mark there about call it $9 to be safe. So if you're looking to go long DWT, maybe an impulsive break over $9, which is right around the top of that range as I zoom in there. And then your next buy signal and a more lasting buy signal on DWT, which is also a sell signal on crude oil, would be a break of this downtrend line right here, which was that uptrend line on USO, and you can see some potential price targets there. And I think we will work our way up here to at least that $15 level in the coming months or so. Bitcoin, this one's played out, as expected for the last few months. I started getting bearish on it down here, looking for a breakout. We had a divergent low, bullish divergence right here at this point, looking for a breakout above the downtrend line. That came with an impulsive break right up to and just above that first target I had there at 77.34. Again, these are Bitcoin futures, GXBT, and we worked our way up to this third and final target that I had here at 90.82. At which point I mentioned we had negative divergence. I was looking for a pullback. Took profits on Bitcoin as well as GBTC, the ETN. Left a little bit of GBTC in some long-term accounts. I'll get to that chart in a second. That's similar to an ETF. That's where you can trade that if you don't have a futures account. But I made clear that when I was going out here, even though we had divergence, I wasn't going to short it. Normally, I might short a trade, and it did pull back. I certainly could have made a little bit of a, or a decent profit, on a short, on a pullback that was, from high to low. Let me just measure that out. That pullback was a decent correction. It looks about 12%. But remember, that's the nature of this beast. Bitcoin is a volatile little sucker. A 12% move is, it was doing 12% or more a day back leading up to the highs. So not a big deal there. But either way, my point is I think that correction is likely over for the near term. Charts aren't that clear right now, but we are above support. That's the important thing, that 90, 82-ish level. We're above support, and I think that pullback's probably as low as we're going to go. Let's look at GBXT real quick here for you. Oh, no, this is GXBT. The next one was GBTC. All these G's, GBTC, trying to remember all these tickers. Can get a little confusing at times, but there it was. You had a divergent low or near divergent low, and as I've mentioned in the past, This is like an ETF, except it's a closed-end fund. So what it'll do, it'll trade at a discount or premium to Bitcoin itself. And in a perfect world, you want to align an entry, a buy point on this when obviously first and foremost when you can make a bullish case on Bitcoin as well as this GBTC, and if this is selling at a discount to Bitcoin. Um, and then when it runs up, just like it was here at the highs, it was selling at a big premium because there are a lot of people that didn't have those cyber currency accounts or another way to buy Bitcoin, but they had a brokerage account so they could, use this as a proxy. But if everybody's buying, 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 as much as Bitcoin was going up, this went up even more and was selling at a fat premium. I mean, there's a 3,000, just grabbing these lows back here from March of 2017. We can go back here. Here it is, 2016 lows from low to high, and I'm using log scaling. So you might say, how is that possible? That's a 5,772% move. So this sucker can move, and again, it can get ahead of itself. But bottom line is, we hit that target. I was looking at 15. Went a little bit above it, pulled back, that held. So just like Bitcoin itself, GBTC is above support. That 15 was a former resistance level, now support, and we're above it. And this is my next target. I think we work our way up there, that 2055 level in overtime. I want to wrap it up here. This video has gone on long enough. Just to point out, CVS is reporting, I posted in the trading room, I think it's Tuesday, if I'm not mistaken, before the market open. That's still an active trade, so keep that in mind. And there's others. Don't forget, there's a earnings calendar on the front page under tools of the trade. And up on the top, when you open that earnings calendar, there's a little search bar. It says ticker. Just type in whatever stock, whether it's an official trade on the site or something you're trading on your own. Not, be aware of when your companies report, and most importantly, be aware of their history. Look at a chart. Go back 2, 3 years, 4 years, and a lot of brokerage platforms or charting platforms will have an option you can check to put a little marker to show you where the earnings reports were. Look for big gaps around those earning reports. Some stocks have a history of gapping around earnings. Others don't. Others manage their expectations or their earnings guidance. They do a good job of managing the guidance, or just do their business, their business model. They might not be subject to those big swings. But my point is, if you are in a stock that has a history of big gaps in either direction, consider reducing your position size, hedging up, or just closing it out, especially if you're close to a profit target. So you avoid having that position gap against you, 5, 10% or more the day after it reports earnings. All right, this has been Randy Finney with Right Side of the Chart. We'll wrap it up here. And again, as earnings season starts to wind down here, we'll start adding some more official trade ideas on the site. Have a great day.